What if I told you that the secret to passing prop firm challenges isn't about finding the perfect indicator or trading more aggressively, but about thinking like a multi-billion-dollar institution? Today, we're pulling back the curtain on how banks and institutional traders operate in the markets, and more importantly, how you can apply their exact methods to pass your next prop firm challenge. By the end of this video, you'll understand the fundamental differences between retail trading psychology and institutional trading psychology, and you'll have a clear roadmap to approach your prop firm evaluation like a professional trader. First secret you need to understand is this: banks don't trade to be right, they trade to make money. And there's a massive difference. Retail traders often approach the market with an ego-driven mindset. They want to predict market direction, catch the bottom, sell the top, and prove they're smarter than everyone else. This is precisely what gets them eliminated from prop firm challenges. The bank's approach: risk management first. Institutions operate on three core principles that directly align with prop firm requirements. First principle: capital preservation. Banks know that staying in the game is more important than hitting home runs. Their primary objective isn't massive profits on every trade, it's protecting their capital so they can trade tomorrow, next week, and next year. This is exactly what prop firms are testing. They don't want cowboys who can get lucky once. They want consistent traders who can manage risk over the long term. Second principle: probability and expected value. Institutional traders think in probabilities, not certainties. They ask, what's my edge here? And what's my risk-reward ratio? They're not looking for 100% win rates. They're looking for scenarios where winning trades outweigh losing trades over a large sample size. Third principle: systematic execution. Banks use clearly defined systems and rules. Emotions don't drive their entries and exits. Their traders follow predetermined criteria because they know that discipline beats intuition in the long run. Let's talk about one of the biggest secrets in institutional trading: liquidity. Banks don't just look at support and resistance, they look at where liquidity sits in the market. And understanding this completely changes how you read price action. What is liquidity in trading? Liquidity refers to clusters of stop losses and pending orders sitting in the market. These are real orders from real traders, and they represent fuel for price movement. Here's what most retail traders don't realize: institutions need liquidity to fill their large orders. When a bank wants to enter a position worth hundreds of millions of dollars, they can't just market buy, they'd move the price against themselves. Instead, they need to find areas where there are enough sellers or buyers to absorb their orders. Where does liquidity sit? Think about where retail traders place their stops. Just below obvious support levels, just above obvious resistance levels, below equal lows, above equal highs, around round numbers. Banks know this. So what do? They push price into these liquidity zones, trigger all those stops, and use that liquidity to enter their actual positions in the opposite direction. This is called a liquidity sweep or stop hunt, and it happens every single day across every time frame. How to trade this like the banks. Instead of placing your stop loss right below support where everyone else has theirs, you need to think one step ahead. Here's the institutional approach. Step 1. Identify obvious liquidity zones: equal lows, equal highs, trend lines that everyone can see. Step 2. Expect price to sweep these zones. Don't be surprised when support breaks or resistance breaks. That's often the setup, not the failure. Step 3. Look for rejection from these liquidity sweeps. When price taps into liquidity and rapidly reverses, that's institutions getting filled and now pushing price in their desired direction. Step 4. Enter with the institutional flow, not against it. Here's another institutional secret. Banks don't trade 24/7, and neither should you, especially during a prop firm challenge. Institutions concentrate their activity during specific trading sessions when liquidity is highest and volatility is most predictable. Understanding this timing is crucial. The three major sessions: the Asian session, London session, and New York session each have distinct characteristics. Asian session, generally lower volatility, range-bound conditions. Institutions often use this session to accumulate positions quietly before major moves. London session, highest volume globally. This is where banks establish their directional bias for the day. The first hour of London, the London Open, often shows a liquidity sweep followed by the true directional move. New York session, especially the first 2 hours when it overlaps with London. This is peak liquidity and volatility. Major institutions are active, and this is often where the largest moves occur. For prop firm challenges, here's the strategic approach banks use that you should adopt. Focus on high probability time windows. The most consistent institutional trading happens during the London Open and the New York Open. These sessions offer the best risk to reward opportunities because volatility and liquidity are at their peak. Many failed prop firm attempts happen because traders force trades during low liquidity sessions, where price action is choppy and unpredictable. Banks don't do this. They wait for their optimal conditions. The institutional daily routine. Professional traders at banks typically do this. Pre-session analysis in the morning. They review overnight price action, identify key levels and liquidity zones, and form a directional bias based on economic data and technical setups. They wait for their session to open. A London-based trader doesn't trade during the Asian session. They wait for London open. They execute during the first 2 to 4 hours of their session. When conditions are optimal, then they step away. Applying this to your challenge. If you're doing a two-step prop firm challenge, you don't need to trade every day or every session. You need high-quality trades during high-probability time windows. Focus 80% of your trading activity on London Open and New York Open. Avoid the Asian session unless you're specifically trained in that market's characteristics. Avoid Friday afternoons when institutions are closing out positions and liquidity dries up. This discipline alone, trading only during optimal sessions, will dramatically improve your consistency and reduce emotional trading. Here's the truth that nobody talks about. Passing a prop firm challenge isn't about being smarter than the market, it's about being more disciplined than 95% of traders who attempt it. Banks don't hire traders who can get lucky for 2 weeks. They hire traders who can consistently apply proven methods with discipline and risk management. When you trade like an institution with patience, systematic execution, and professional risk management, you don't just pass prop firm challenges, you build the foundation for a genuine trading career. The market rewards professionals, not gamblers. The choice is yours. If you found this valuable, make sure to implement these concepts in your next challenge. Start small, be patient, and trade like your capital is the most precious resource you have, because it is. Good luck, trade safe, and remember, think like a bank, trade like a professional.